So in an income-based valuation, we'll have a look at the financials of a business, and we'll have a look at their EBITDA or their shareholder discretionary earnings, or there's different benchmarks where we can have a look at the business, and each one will have a different multiple associated with that value. We get that multiple from industry data and some other risk factors that we subscribe to. And at the end of the day, we take that multiple with that value to come up with an overall valuation and then weight average it. On the market side, we will have a look at privately owned or publicly owned companies if need be, find out what those companies were either worth or what they actually sold for on the open market, if they're within the same industry, and we'll come up with a ratio. Could be price to revenue, could be price to earnings, and then have a look at our target client and see what if we use that multiple against, or that ratio against the financials of the current company, what would they potentially get on the open market.
Oftentimes we'll go to the done deals marketplace and see what has been done in the past. The problem with that is every transaction is unique. There's so many components in a transaction that it's really hard to come along and say, well, because the ABC restaurant sold for so much money, my XYZ restaurant must be similarly priced. That's fairly common, quick acid test, but it's not a good test of what the true value of the business is, because it doesn't take into consideration all the idiosyncrasies of business transactions. To illustrate that a little bit, I've been involved in at least 1,000 transactions in my career, and I can honestly tell you no two have ever been the same. So using those ratios on done deals is a quick acid test. Are we in the ballpark? But it's not something one should rely on totally. Publicly traded vehicles, in the earning multiples applied to them, or they call it the price-earnings ratio, is quite a bit different than in the private company sector. First off, public companies, their stock is trading every day, so it's liquid. So you buy today, you decide you don't like it tomorrow, and the following day you can sell it. Once you buy a private company, selling it is an undertaking that's good for 6 months to 2 years or even longer. So that's one factor, is the liquidity, ease of getting in and out of the investment makes it less risky, so you can sell it for what you paid for it, or perhaps a little more, or perhaps a little less, but the risk is lower, so the earning multiple would be higher. Earnings number falls through the operation from EBITDA to earnings after interest to earnings after depreciation and amortization to earnings after tax. The multiple grows, and it should never be compared with the earnings multiple of a company where the multiplicand is higher up in the chain, like shareholder discretionary cash flow, EBITDA, those kind of numbers.